What is up, YouTube? We're back here with the new year and a new video. Today we're going to be going over kind of the next step in stocks and trading, which after just trading stocks themselves or mutual funds, it seems like the next step would be to get into options trading. So we're going to go over a little bit about what that is, what it entails, and then do a little on-hands demo. So options are generally a way that people can speculate or hedge their money against what they think stocks are going to do. So they can bet that a stock is going to go up in value or down in value, and there are different options that they can take depending on which direction they think it might go. Betting that a stock will go up in value is considered a call option, as they call it. And if you're going to bet that a stock's going to go down in value, that is a put option. And those terms we'll be using here as we look at actually performing this and looking at something that they call the options wheel, which is a strategy we're going to attempt to do this year and throughout the year and see what kind of returns we can get, what kind of money we can make doing it, and how easy it really is. And it's supposed to be easy for anyone to implement. So we're going to look at a chart here that kind of explains it and then try to follow those steps and see what happens. Now, when it comes to options, there are kind of two sides to them. There is the selling of the options and there's the buying of the options. Buying the options is generally the more risky considered way about going about them, which is more of the gambling aspect. You're betting that stocks are going to go up, so you buy an option to buy stocks at a certain price, hoping that it goes above that price, and then you can collect whatever that difference is, both above or below the stock price. But what we're going to be doing is the sell option. So we're selling options, and if you do it at the correct price based on how much you spent for a specific stock, then you can make money doing this because people won't end up acting on the option that they bought, and you'll be able to collect the premium. Alright, we're taking a look here at this chart that I built out, a bit of a workflow, I guess you can call it, for the wheel options trading strategy. This isn't something that I came up with, but it's something that a lot of people talk about and a lot of people implement, and I tried to make it easy to understand with this chart. So there's kind of two entry points. One of them is you already have 100 shares of a stock, and you'll start here, or if you have cash for 100 shares of a stock at a particular price, you can start on this end. So we'll walk through it from over here. This is the strategy entry point that we'll be taking. We have 100 shares of both SoFi and Rivian, so we'll be entering here and performing this strategy from this point. So we're going to sell a call option at or above average cost basis. Average cost basis is the average cost that you paid for all 100 shares of that stock. Now, the reason why we want to sell the call option at or above that cost basis is if the price does go above the price of that option, then you'll end up selling all of those stocks, as you can see in this line. Stocks go up, you'll end up selling all those stocks, and since you're doing it above your average, you'll make a profit at least. Now, if the stocks were to go down, obviously people won't want to buy the stocks at that higher price that we set the option at. Therefore, you'll collect the premium that they paid for that option, and you will keep your stocks. And there's a bit of a loop there if you continue to have the stocks go lower than whatever your option is. Say we follow this track though, we end up selling the stocks, then we'll be put into the put loop. You'll be able to sell a put option on or below your sell price. So say the stocks went up, you ended up selling stocks at $10 per share. Now that we're selling a put option, we don't have an average cost basis for our stocks because we don't have them anymore, but we know we sold them at $10. And so to avoid losing money on an option, if we were to buy more stocks, we want to set that put option on or below that $10 sell price from before. So then if the stocks were to go down, we will then purchase 100 shares of that stock. If the stock goes up, we'll collect the premium for that option and continue that loop. And it loops back into the other side. And you can see how it's kind of like a wheel because you kind of loop back and forth, and there's a bit of a circle going on here with 2 inner loops. But that's basically the strategy we're going to do, and we'll take a look at actually performing the first step, which is selling a call option. All right, so we got Fidelity here. This is the brokerage account that I use to be able to sell options. As you can see here, if you click to trade options, you need to have an account approved. If you want to do this, usually you can just go about opening up the options application. In doing this, you can then go in, hit manage, and you just fill out a simple application. And the tier 1 application, there's a couple tiers. Tier 1 is all you need to be able to do options trading, and they approve you pretty quickly if you're able to do so. Coming back to the trading window, we're gonna go to keep the options, choose your account that is approved for options trading. You can see here tier 1 has been approved. And like I said, we have 100 shares of Rivian that we're able to do this with, and SoFi. So today we're just going to do SoFi, and then probably switch back and forth between SoFi and Rivian as we go along. But what we're going to want to look at here is to sell to open. So we want to open one call option. This may change. You gotta kind of play with the date and the strike price. So this is what we were looking at back at our chart. We want to sell call at or above average cost basis. So we have my position open down here below. So if we look at SoFi and we come over here, our average cost basis for SoFi is $8.58. So you want your strike price to be at or above that. And it isn't super, I would say that it is more risky to put it closer to that, especially if the price is already at $8.50, which it is. So we're going to look at maybe $9.50. So that would put us at 3 cents per share, which is what the premium would end up being. If you multiply that by 100, you get your total premium, which would be only $3, which isn't great. Now, a way to increase that number is to put the expiration date of your call option out a week. So if we do that and look at the numbers, we're now looking at $9, which is a lot better than the $3 we were looking at before. And a couple things factor into this number. One of them being just the price of the stock itself. The stock is not worth a whole lot. $8 isn't a huge number, and so having 100 shares isn't a ton, and people can't make as much money betting on this stock. Another factor is the volatility, or they sometimes have a number called the beta, which will give a bit of an indication as to how volatile a stock is, how likely it is to go up or down in value, and that could also increase this number. But we're going to go 2 weeks out here with a strike price of $9.50, and then you can just put your limit at that midpoint and then double check everything here. So there are some fees included in this. We're looking at a 40-cent fee, and our estimated leftover would be $7.60. So if we preview this order, what I'm going to do is go ahead and fill out this sheet that I kind of pre-built in Excel so that I can keep track of these trades. So we're going to take SoFi as our ticker. Our expiration date we set as January 19th. So that's 01/19/24. We are selling a call strike price is $9.50. We can format that. So our premium we're looking at $7.60. Format that one as well. Exit cost is just the fees, so 40 cents. So I guess the premium is actually the $8, so we can change that to $8. And then the profit would actually be this minus this. We can hit enter. And then we'll keep track of total profit as we go along, but this will be our first executed option trade. We can go here and place our order. And the order has been received. Now, this won't necessarily get fulfilled right away, but if we take a look, if we go and fill out this same information, set it up, one call expiring then at 9:50, then we can see the volume of how many options are being sold and bought. So this kind of gives you an indicator of how much interest there is in trading options with a particular stock. So it's likely that this will get fulfilled during normal market hours, and we'll have to follow up with what actually happens. Okay, so what we've done today is we started with 100 shares of SoFi. We set up an order to sell a call at a $9.50 strike price. That's above our average cost basis, which was $8.50 like we showed. So currently we're at this stage. If the stocks go up and above that $9.50 strike price, then we'll end up selling all of the stocks and we'll enter into this part of the wheel. If the stock's price goes down or it just doesn't go above that $9.50 strike price, then we'll collect that $7.60 profit and we can do it again. And that'll be in 2 weeks on January 19th when we'll know the result of this option. Anyways, guys, I hope you enjoyed this video and you learned a little bit about options trading. I know I'm going to learn a lot going through this process, learning how to be more effective at the wheel strategy and learning how to manage my portfolio better. I hope you guys learn a lot along this journey with me, and I hope you guys come and watch next week's video as we'll be performing the same thing but with Rivian. So we'll see what their options are looking like. That stock's worth a bit more than SoFi, so numbers are going to be different, the premiums will be different, and we'll be able to compare the difference between a lower price stock and one that may be a little more expensive. But thank you guys for watching. It means a lot, and I'll see you guys next time. Thanks.